This is Terrence Andre Banks with Information Age Financial Solutions, coming to you with a fantastic article I read from Economic Prism, the upshots of the new housing bubble fiasco. With everything going on in housing, it's just good to read articles like this that keeps things kind of grounded and giving you a full picture of where we're at, and where we're going, and where we're at currently. Can't stress enough, I'm going to put a link inside the description. Let's dive in. It's a lengthy article, but definitely worth your time. I'm going to start reading it, and I would encourage you, any parts that I'm missing, or read it for yourself. The epic housing bubble and bust in the mid to late 2000s was dreadfully disruptive for many Americans. Some never recovered. Now the central planners have done it again. On Tuesday, the Federal Housing Finance Agency released its U.S. House Price Index for September. According to the FHA, HPI, U.S. house prices rose 18.5% from the third quarter of 2020 to the third quarter of 2021. By comparison, consumer prices have increased 6.2% from a year ago. That's running hot. But 6.2% consumer price inflation is nothing. House prices may have inflated nearly 3 times as much over the same period. Here in the Los Angeles Basin, for example, things are so out of whack, you have to be rich to afford a 1,200 square foot fixer-upper in a modest area. Yet the clever fellows in Washington have just the solution. Massive house price inflation has prompted FHA and the government-sponsored enterprises GSEs it regulates, Fannie Mae and Freddie Mac, to jack up limits of government-backed loans to nearly $1 million in some areas. Wow. Specifically, the baseline conforming loan limit for 2022 will be $647,000, up nearly $100,000 from the last year. In higher cost areas, conforming loans are 150% of baseline, or $970,800. What gives? If you recall, ultra-low interest rates, courtesy of the Federal Reserve following the dot-com bubble and bust, provided the initial gas for the 2000s housing bubble. However, the housing bubble was really inflated by Fannie and Freddie Mac. Interesting. The GSEs relaxed lending standards and thus funneled a seemingly endless supply of credit to the mortgage market. The stated objective of the GSE was to make housing affordable for Americans, but their efforts did the exact opposite. The GSEs puffed up the housing market to a place where average Americans had no hope of ever being able to afford a place of their own. Then when the pool of suckers dried up, above the time rampant fraud and abuse cracked the credit market, people got destroyed. If you also recall, it wasn't until credit markets froze over like the Alaskan tundra in late 2008 that the Fed first executed the radical monetary policy of quantitative easing. So true. I love how he points out the timelines here. And if anyone who were not around the dot-com or the 2008 recession, they're not aware of this, and it's definitely why I think this article is definitely worth your time. To be clear, QE has nothing to do with the last housing bubble, ultra-low interest rates, and GSE intervention to trick on their own. QE came after. But now in the current housing bubble incarnation, the Fed's bubble buying $40 billion in mortgage-backed securities per month since June 2020. Is there any question why housing prices are going vertical over that time? So true. The Fed is now tapering back its mortgage and treasury purchases. This comes too little too late, and with Fannie Mae and Freddie Mac now jacking up their confirming loan limits, house prices could really jump off the charts. We'll have more on that current intervention efforts of GSE in just a moment. But first, to fully appreciate what they're up to, we must revisit the not-too-distant past. Socialized losses. A moral hazard is the idea that a person or party shielded from risk will have behaved differently than if they were fully exposed to the risk. A person who has automobile theft insurance, for instance, may be less careful about securing their car because their financial consequence of a stolen car will be endured by the insurance company. Financial bailouts of both lenders and borrowers by governments, central bankers, or other institutions produce moral hazards. They encourage risky lending and risky speculation in the future because borrowers and lenders have believed that they will not carry the full burden of the losses. Do you remember the savings and loan crisis of the 1980s? The U.S. government picked up the tab, about $125 billion, a hefty amount at the time, when over 1,000 savings and loan institutions failed. What you may know is the seeds of crisis were propagated by Franklin Delano Roosevelt during the Great Depression when he established the Federal Deposit Insurance Company and the Federal Savings and Loan Insurance Company, FSLIC. From then on, borrowers and bank lenders no longer had concern for losses, for they were covered by the government. The savings loan crisis confirmed this and further propagated the moral hazard, culminating in the subprime lending meltdown. Obama's big bank bailout of 2008 to 2009 socialized losses. Then the Fed's QE and the ultra-low interest rates furthered the moral hazard. These are now the origins of the current housing and mortgage market bubble and future busts. By guaranteeing mortgage securities up to nearly $1 million, in some areas the government encourages risky lenders risky lending by banks and speculation by investors. Banks are less prudent about what they loan to many because the loans will be securitized and sold to investors. Similarly, investors speculate on these securities because they are guaranteed by the government. Once again, the government is promoting a heads I win, tails you lose milieu, where banks and investors reap big profits, take on big risks, and where the losses are socialized by taxpayers. It also sets the stage for massive grift. The anatomy of a swindler. Sorry, those are the words there. FDR, the 32nd U.S. president, was responsible for setting up Fannie Mae, while another FDR, Franklin Delano Raines, was responsible for running it into the ground. The son of a Seattle janitor, FDR grew up knowing what it was like to have not, including at a young age it was better to have. It was like while mixing with Ivy Leaguers in Harvard University and at Harvard Law School, where he really refined his thinking. He came to believe the government should be responsible for supplying the have-nots with taxpayer-sponsored philanthropy. FDR came out of school with the wide-eyed ambition of a lab rat. He was determined to sniff out his way to wealth and once for all find that the ever-elusive cheese at the end of the maze. The first corner he appeared around smelled remarkably prospective, but he came up empty. 3 years later, the Carter administration didn't offer the compensation he dreamed of. To have was better remember. The next corner FDR appeared around was much more lucrative. He did an 11-year stint in an investment bank, but it was in 1991 when FDR got his break. For then he became Fannie Mae's vice chairman, and it was then he gained hands on the access to market with the lives of millions. Still, he wasn't quite sure how to go about it. To learn such tips and tricks, FDR studied one of the true masters of our time, Bill Clinton. From 1996 to 1998, he was the Clinton's administrative director of the U.S. Office of Management and Budget. Then he discovered you must have a vision, a mission, a delusion that is so grand and so absurd, the world will love you for it. One evening in the autumn of 1997, came to him in a flash, staring deep into the pot of his chicken soup. I'll skip over that yet. For where Hover has foreseen chicken soup in every pot in the car and garage, FDR now foresaw how much more. Chicken and car were not good enough. In FDR's world, everyone should get a house with a pot to cook chicken in and a garage to park the car in, and he knew just how to give it to him. Yet best of all, FDR also knew he could become remarkably rich pawning houses of John Trotter. So in 1999, returned to Fannie Mae as a CEO and got to work on his master plan. Fraudulent earnings statements. It was a pretty simple 4-point plan. If low interest rates make housing affordable, then lower interest rates make housing even more affordable. If 20% down at putting house out the reach of some, then 10% down was better, and 0% down was optimal. Similarly for borrowers, credit score doesn't meet the requisite credit standards, just relax the standard. And lastly, if a borrower income is too low to qualify for loan, then just state whatever income it is that they must have to get the loan. With the ground rules in place in 1999, FDR began the pilot program that would ultimately ruin the finances of the Western world. It involved issuing bank loans on how to moderate income earners. I'm going to skip down a little bit. Here we go again. On June 23rd, 2021, Collin versus Yellen, the Supreme Court decided the president could remove the FHA director without cause. The next day, President Biden replaced Trump's director of the FHA, Mark Caliber, with a temporary appointment. FHA, as noted above, regulates government-backed housing lenders, Fannie Mae and Freddie Mac, prior to getting his pink slip. Biden's replacement immediately reversed course and reinstituted the social engineering policy that brought down the housing market in 2008. Acting Director Sandra Thomas. There's widespread lack of affordable housing and access to credit, especially in communities of color. It is FHA's duty through our regulated series to ensure that all Americans have equal access to safe, decent, affordable housing. One could mistake these words for Franklin Delano Raines. Certainly the madness it forces will be the Raines like the Wall Street Journal report. The problem Biden sees is that housing and rental prices are too high. The fact that the administration's own policies have caused an inflationary trend in housing along with food, energy, and gasoline, among others, is no deterrent. The administration wants people who would otherwise rent to become homeowners. These young families would take the risk on the burden of a mortgage with the government through Fannie and Freddie Mac, which makes things cheaper. Investors, of course, will buy these risky mortgages from Fannie and Freddie Mac because they are backed by the government. Here we go again. The only difference between what the administration is proposing and what brought about the 2008 financial crisis is that the economy is already in an inflationary period induced by the administrator's other policies. This will make ownership even riskier. In addition, Fannie and Freddie will be buying mortgages of up to $1 million instead of $450,000. But the government's lower underwriting standards give down standards for private lenders too. Banks and other mortgage lenders they want in the business have to offer their mortgages on similar terms. People who own homes then dive into the market to take advantage of the few of the low down payments and housing prices even faster. This encourages cash out mortgages, in which homeowners reduce the equity in their homes, sometimes to buy a boat. The process goes on for years until the prices are so high that sales growth falls and homeowners can sell their homes to pay off and can't sell their homes to pay off their mortgages. Housing prices then collapse, mortgages go up unpaid. Banks and other lenders, even Fannie and Freddie, incur losses and other financial crisis begins. The upshots of the new housing bubble. Housing prices are already in bubble territory in places across the country. At these prices, who's buying? Wall Street, pension funds, BlackRock, and many, many others. Institutional investors have securitized residential real estate market. Hundreds of firms are competing with regular house buyers. That's true. They're also bidding up house prices. Invitation Homes, for example, is a publicly traded company that spun off BlackRock in 2010. Invitation Homes gives billion-dollar loans on interest rates around 1.4%, about half the rate of what regular home buyers get. Oftentimes, they just pay in cash. According to a recent DSE disclosure, Invitation Homes' portfolio of houses is worth $16 billion. The company comes to about $1 billion in rent per year. Thus, it takes only about 8 years of rental payments to pay back a typical house the Invitation Home has bought. Invitation Homes now owns over 80,000 rental houses and a market capitalization of $24.6 billion. The company has deep pockets. Regular house buyers cannot compete. No doubt this is an ugly situation. This ugliness is created by institutional investors. They're merely scratching yield in a world where capital markets have been destroyed by the Fed. Of course, there's no situation that's too ugly for Washington, not making it uglier. Wow. House prices will go down along with the hopes and dreams of those that got sucked into the wickedness. Senate challenges will be flummoxed, Congress will socialize losses once again, and populist rage will be channeled into some new Occupy Wall Street movement, then things will really get ugly. These and many more are the upshots of the new housing bubble fiasco. And Gordon for Economic Prism. Again, I skipped around. I read a lot of it. I can't stress enough to read it because he does this deep consolidation, explaining and using FDR and different terms in that point. And you may get, instead of Franklin Delano Roosevelt, Reigns. It's really well done. Fantastic article. Even if you disagree with it and believe that housing is here to stay and nothing can go down, it's always going to remain these high prices, it's always good to hear a different side of the spectrum so you can make the best decision for yourself. If this video has been of any value to you, please subscribe, leave some comments, hit the like button. And for my next video on Information Age Financial Solutions, I'm out.